Whenever I'm dealing with a problem that deals with balance sheet accounts and especially debt and redeeming debt before it's actually mature, I'm a very visual person. I need to see what's going on within the account. So for this problem, I'm just going to quickly show you what the accounts look like on the balance sheet. And for this company, they have bonds payable at the face value. Let me just format this here quickly. The face value of the bond, so if this were the T account, they would have a credit balance, right? Because the debit balance versus the credit balance liability goes up on the right side. It'd have a $700,000 value sitting here, and we're told that this bond has a carrying value of 676,288. Now you need to be able to infer what does that mean, especially when you're looking at the accounts. It tells us logically the bond was sold at a discount. If the carrying value was less than the face value, it had to have been sold at or issued at a discount. If the carrying value is greater than the face amount, then it would have been sold or issued at a premium. So we've got another account called the discount on the bonds payable. And this is going to have not a credit balance, but a debit balance. Remember, this is a valuation account, a contra liability. So it's the difference between the 700,000 and the 676,288. So we currently have $23,000 sitting there in that account. Okay, and so when the bond is redeemed or matured before maturity, that means that this bond will have a $0 balance after it's redeemed. It's going away. And logically, the discount or the premium that's associated with that bond also will have a $0 value. So the end goal is to get to zero, right? And that's logical. So we're going to have to debit bonds payable for that $700,000, and we're going to have to credit the discount on bonds payable for the $23,712 to get it to go away as well. The other piece of the transaction is that the company that's issued the debt is going to have to come up with cash to redeem the bond. And it says here the call price upon early redemption is $685,000. So what that tells us is that the company is going to have cash that goes down signified by a credit by $685,000. So now I've got all these pieces of the puzzle here. I can construct the journal entry that's going to be required of Northwest Manufacturing Company to redeem the bond. And they said the bond is redeemed on January 1st of 2016. And we're going to go ahead and debit bonds payable, remember, because that's going to net to zero when we're done with the transaction. So that would make this, if we posted it right away, the balance is zero. My cash will be credited by 685. I'm going to skip a line here. Credit cash for 685, right? Because that's what we're doing. We're taking out of our cash to redeem the bond, the debt, and the discount on bonds is also going to be credited by 23,712. Okay, so once we have these pieces of information, we can quickly determine that our journal entry doesn't balance. It's off by the 8712, and that's the amount we're going to plug. And that's going to either be a gain or a loss, and you just need to be able to look at this and logically understand that this is a loss, right? Because debits indicate a loss. Loss on bond redemption or something like that. If it were credit, that would need to be plugged here. It would be gain on bond redemption, and that becomes an expense or another expense or another income item in the current accounting period. So that's how I suggest you work through a problem like this. The fact that the bond was previously issued to yield 14% is irrelevant if they give us the carrying value. We had to determine whether it had a discount or a premium, and then logically work our way through the accounts and figure out what the ending balances should be, and then make them so with the journal entry.